Matt the Mortgage Guy here. I want to make a quick video to talk about the impact of low interest rates. And in this world of super low interest rates, where there's all kinds of buzz about people out there buying houses because rates are super low and how the low rates increase your purchase power and whatnot, what people really want to know is, how does this impact me? What are the real numbers behind rates are low? It's a great time to buy. So I want to give you a quick example. Now, for example's sake, this $375,000 purchase at 3.75% interest rate, you can think about this as this is where rates used to be, and maybe this is where the home price used to be. Or you can even think about it of, what if I don't buy now and I buy later and rates go up to this and I buy at that. So however you want to look at it, it's just comparing a higher rate and a lesser purchase price to a lower rate like we have today and a higher purchase price. So here we've got $375,000 purchase price, 5% down. That's the loan amount at 3.75% interest, principal and interest, homeowners insurance, property taxes, and mortgage insurance. Total payment of $21.71 a month. Again, $375,000 purchase, 5% down at this interest rate, 3.75%. Now, we want to look at someone buying a $400,000 house with that same 5% down, and let's say they can get a 2.999% rate. Today, this is about the rate somebody with good credit can get on a 30-year fixed. 30-year fixed. So we plug in these numbers. Principal and interest is $1,602. I based the homeowner's insurance and the taxes off of the purchase price. So the homeowner's insurance is slightly more expensive because it's a higher purchase price, and the taxes, Sacramento and most surrounding counties are about 1.25%. So that's based on that. And mortgage insurance at this higher purchase price is higher. Since the rate is lower, principal and interest lower, the total payment is actually lower. So if you hear people talking about purchasing power, how your purchasing power is higher when rates are lower, this is what it means. If you qualified for a mortgage of $21.75 a month, and that only meant a $375 purchase price, back when you talked to somebody and rates have now gone down to this, you can now buy at $400,000. The payment's smaller, and when you qualify, it's based on the payment. If the rates go down, you can qualify for a higher mortgage because that mortgage at a higher purchase price is lower or equal to what it was at a lower purchase price. So that's just a quick example. The cool part about this is, 30-year numbers I don't like to do because you're probably not in this loan for 30 years, but you pay $25,000 more over here. But if you stay in both loans, the total amount spent, $576K versus $593K, is less on this larger purchase because of that interest rate. And that's the cool stuff I like as a math guy and as a mortgage guy. Another quick thing is I did a little analysis on 10 years into this loan, how much you owe. And even though you start off owing almost $24,000 more because it's a higher purchase price, remember, within 10 years, you've narrowed that gap to only $10,000. So a lot of times, the purchase price is less important than the interest rate. And if you can get great terms like a 30-year fixed below 3%, my opinion is that it's a great time to buy. Any questions at all, please feel free to reach out. Until next time, Matt the Mortgage Guy.